Yes. Good afternoon, students. Good afternoon, sir.
Good afternoon.
Yes, students. Today's topic is, as you all know, audit report. Or sir has beautifully explained relevant essay beautifully last lecture में with case studies, with Infosys auditor report. सर ने बहुत अच्छे से स्टूडेंट्स एक्सप्लेन किया था और आप आज का लेक्चर भी उतनी बहुत अच्छे से सुनना और बड़े ध्यान से सुनना ताकि जो इसमें ऑडिट रिपोर्ट फाइनल आउटकम है, जैसा कि सर ने समझाया था कि ऑडिट के लिए सीए के लिए फाइनल आउटकम है, ऑडिट के लिए फाइनल आउटकम है ऑडिटर रिपोर्ट। तो उसमें स्टूडेंट्स ऑडिट रिपोर्ट सर ने बोला था कि ज्यादातर सीए क्या करते हैं, वो फाइनेंशियल स्टेटमेंट्स पे सेल्फ वर्किंग करना शुरू कर देते हैं कि कौन सी मतलब अकाउंटिंग एस्पेक्ट्स ज्यादा देखने लग जाते हैं, जबकि हमारा जो एस्पेक्ट है बीइंग ऑडिटर वी हैव टू वर्क ऑन ऑडिट, वी हैव टू focus on audit evidence, then audit evidence we draw conclusions from the audit evidence, and from conclusions we form audit opinion, and from audit opinion then that is presented in the audit report. So with these words, students, yes sir, you can start, sir.
Yeah, thank you. Good afternoon, everybody. I'll share my presentation. Last evening, I think Wednesday evening, we stopped at 706. We spoke of 700, 705, and 706. Today, we speak on two more important standards relating to audit report, which is 701 and 720, after which I'll take you through the CARO findings. 701 is a standard which deals with communicating key audit matters in the independent auditor's report. In short, it's called CAM. CAM is a very common acronym for key audit matters. So what exactly is key audit matter? Are those matters that in the auditor's professional judgment were of most significance in the audit of the financial statements of the current period. So this is a mode of communication to the reader कि what according to you in your professional judgment was the most significant matter in the audit of financial statement which you would like to bring to the attention of the reader. Key audit matters are selected from matters communicated with those charged with governance. So SA 260 deals with matters to be communicated with those charged with governance. And so out of the matters that you communicate with those charged with governance, what you feel is the most significant portion of your work, you will cover them under CAM. So therefore, you cannot do a CAM out of areas that you have not communicated with those charged with governance. CAM is required to disclose by all listed entities. To whom is CAM applicable? By all listed entities, and those entities that are components to a listed consolidated financial statement, as the holding company auditor may request for mention of CAM in his component audit letter. So, an unlisted subsidiary of a listed company, strictly speaking, CAM is not applicable. But if the holding company auditor requests for a CAM to be mentioned in the component auditor's letter, then he may mention that also. Otherwise, it is mandatory for all listed entities. However, there is no bar on including CAM in an unlisted entity not covered by above, as it is the auditor's prerogative to mention and report matters that he considers significant to the reader of the audit report. So you may be doing an unlisted company, which is of very high importance, and you may feel that I want to talk about a CAM. You can tell a CAM, you can cover a CAM in your unlisted company's auditor's report also. There is no bar or there is no restriction on you reporting a CAM even in an unlisted entity. But for a listed entity, it is mandatory that you report on a CAM. Why should it be reported? The objective of reporting is to determine key audit matters and, having formed an opinion on the financial statements, communicate those matters by describing them in the auditor's report. The purpose of communicating key audit matters is to enhance the communicative value of the auditor's report by providing greater transparency about how the audit was performed. So what is the purpose? The purpose is to enhance the communicative value of the auditor's report by providing greater transparency about the audit that was performed. Communicating key audit matters also assist intended readers in understanding the entity and areas of significant management judgment in the audited financial statements. What need to be covered in as CAM? There are primary issues that are reported to those charged with governance. They are areas or matters that require significant auditor attention, areas of higher risk of material misstatement or any significant risk identified as per SS 315, areas requiring significant auditor and management judgment, including accounting estimates involving significant estimation by management, like an impairment testing, etc., and the effect on the audit of significant events or transactions during the period. Please note, CAM is not a substitute to modification of audit report. That is, an auditor cannot make a CAM reporting instead of issuing a modified report. So if you do not have sufficient appropriate audit evidence, and therefore you are unable to issue a unmodified report, you cannot avoid modification by including those matter in CAM. So CAM is not a substitute. So last time I explained to you under what circumstances you can issue an unmodified opinion. So if you cannot issue an unmodified opinion, please do not issue an unmodified opinion. Don't say yes when you want to say no. Please make that as a point when you're an auditor. If you cannot issue an unmodified opinion, do not issue an unmodified opinion. Modify as per the terms of 705. And don't think that if I report that matter in CAM, I can avoid a qualified report because client is putting pressure on us and I can give an unmodified opinion. CAM is not a substitute to modification of report. Similarly, a matter of material uncertainty relating to going concern needs to be specifically reported in accordance with SA 570 revised and cannot be made a key audit matter for reporting under SA 701. So similarly, if you want to report a matter of material uncertainty relating to going concern, you need to specifically report it as per SA 570 and you cannot make it a key audit matter for reporting under SA 701. These are not escape routes. You cannot absolve your responsibility by mentioning under a wrong standard. It is also not a substitute for disclosure of a particular matter in the financial statement. So what is to be disclosed in financial statements has to be disclosed in financial statement as per the framework, financial reporting framework. Financial reporting framework can be either company's Indian accounting standard, which we call Ind AS, or the company's accounting standard rules 2021, which is typically called the IGAP. So, and read with Schedule 3. Schedule 3, Division A deals with IGAP account, Division 2 deals with Ind AS accounts, and Division 3 deals with NBFC accounts. It is also not a separate opinion on an individual matter. So it doesn't affect your opinion. That is why if you recap quickly the sequence of the audit report, I told you these paragraphs appear after the opinion so that a reader does not feel that there is a bias in the opinion. This is additional information after expressing your opinion. How does one communicate? The auditor gives a description of the CAM, including why was it a key matter, how was the issue addressed by way of description of the audit process, and conclusion on the matter. This is how you communicate. This is either to be described paragraph-wise or in a tabular format. The preferred route which most auditors take is the tabular format. So you have serial number, the key audit matter. Here you describe the audit matter and what was the response to the key audit matter and the principal audit procedures. You may have 1, 2, 3 audit matters and how the same was, what is the audit matter and how did you address and what audit procedures you took to address the same. So once again, we will look at Infosys report to see how Infosys auditors picked up 2 audit matters as key and how they reported it and what was the response to the key audit matter after this section is over. There can be situation where CAM is not reported. if there is a law or regulation which precludes public disclosure of the issue. So if there is a sensitive issue and disclosing that could affect the issue, and there is a legal embargo or regulation which precludes the public disclosure, then you may not issue CAM. In extreme circumstances, the auditor may conclude that the adverse consequence of such disclosure will far outweigh the public benefit of such disclosure. However, this will not be the case if the matter is already publicly disclosed by the management. You cannot take the stand if the matter is publicly disclosed by the management. For example, there could be a fraud, there could be some serious matter, and disclosing this would affect the the judicial process or the investigation, then you may not. But if the company management has already disclosed this matter, then you cannot say that by disclosing this, I will be it'll affect the proceedings, and therefore I will not do it, because once it's already been done, it's in public space. Auditor, however, needs to communicate to those charged with governance of the reason and situation why he did not make a CAM, and that has to be documented. CAM disclosure and modification opinion paragraphs. Matters that are part of audit opinion modification, either as a qualification, adverse, or dissent opinion, do not need mention once again as a CAM, although these by their nature are key audit matters. So you don't have to say, repeat what you have repeated in your qualification on adverse basis of opinion or dissent or opinion basis, because they've already been disclosed. You don't need to repeat them, although they were key audit matters. They need to be disclosed as per applicable SA, namely SA 705. Similarly, a material uncertainty relating going concern being disclosed in accordance with 570 does not need a separate mention once again as a CAM. Although that matter would also be a key audit matter, which you must have dealt with lot of importance and lot of time must have been spent, but that does not mean you repeat the same thing under CAM. Ideally, in those circumstances, you say, apart from what is stated in the so-and-so, in the basis of qualification or basis of adverse opinion or material uncertainty going concern, the following are the key audit matters. In such situation, it is advised that a CAM paragraph mention that apart from the matters forming basis of qualified opinion, the following are the other CAM. CAM and EOM. Once a matter is included in CAM, the auditor may still think it necessary to make a mention inviting reference by including the same matter under the emphasis of matter paragraph. So while CAM and audit qualifications don't have to be repeated, but a CAM and emphasis of matter paragraph can be repeated. It is also possible that a particular matter may not be a CAM, but the auditor may consider it necessary to make an attention inviting paragraph by including the same under the emphasis of matter paragraph. So don't think that if you make an EOM, because an EOM could be a continuing EOM from an earlier period, but it is not a key audit matter for the current year. That's a possibility. So while you may include an emphasis of matter paragraph, you may not necessarily treat that as a CAM. You would not be wrong if you don't repeat that in CAM. Both situations are possible and there are no fixed rules around it. The principle is that it should make better reading and understanding to the users of the audit report. So please note that this is the most important principle. It has to be a better reading and better understanding to the users of the audit report. No CAM. It is possible that there are no key audit matters requiring disclosure. In such a situation, however, the CAM paragraph in the auditor's report is required to be included. You cannot avoid it that there is no CAM, and you have to expressly mention that there are no key audit matters requiring disclosures. So please note, in case of a listed company, you must have a CAM paragraph. Either you include 1, 2, 3 CAM, or you carry a note that there are no key audit matters requiring disclosure. But you cannot avoid the paragraph merely because there are no key audit matters that you need to disclose. Therefore, inclusion of CAM paragraph heading is a mandatory inclusion in case of a listed company. But the audit has to be really very smooth with very little issues and complication in the execution and very little judgmental calls for there being no CAM at all. So be very careful when you decide that there is no key audit matter requiring disclosure. Now, before we go to SS 720, I'll quickly take you through Infosys audit report once again, where we will deal with CAM. This is the report of Infosys issued by the auditor for March 24. Now, see this key audit matter. So they have decided not to have a columnar report. There is no fixed format. It's your choice. So first they dealt with the issue. The company's contract with customers include contracts with multiple products and services. The company derives revenue. So they've explained the issue and the auditor's response to it. For the interest of time, I'm not repeating this. Any of you can Google and get the Infosys audit report. So they have explained the issue and the auditor's response. Principal audit procedures performed, including the following. So what did they do to address the key audit issue and how did they conclude? So they picked up a sample, obtained and read contracts, identified significant terms and delivery. And the next issue was that revenue recognition for fixed price contracts. So there were two camps. So once again, they explained the whole issue, what exactly is the issue, and how did they address the issue, and what audit procedures they followed. This brings about to the reader that revenue recognition in case of fixed price contract and revenue recognition per se in the case of Infosys are key audit matters. They take significant time and effort of the auditor and significant judgment calls are taken by the auditor, and therefore they thought it necessary to include revenue recognition. So there is a institute publication by I think CAQ, which has a list of all CAMs, all qualifications, and all matter and certificate paragraphs, which makes very interesting reading. There's a booklet which they have come out with. If you Google and find out, you will come to know that there is a booklet which has captured the various disclosed CAMs, disclosed audit qualification, CARO qualification, CARO paragraphs, everything is there in the document. So it makes very wonderful reading. And before you decide to qualify, you may go through them to understand how others have done it so that it forms a basis for you to form your opinion. Please do not copy paste because the facts may or may not be similar in your case. So you have to be very careful before you copy verbatim. The last portion of the 700 series is SA 720, Auditor's Responsibility Relating to Other Information. What is other information? What is the purpose of this standard? I touched upon it briefly during my last session. This is the portion where I will deal with it in more detail. This standard deals with the auditor's responsibility relating to other information in an annual report, whether they are financial or non-financial. So if you know, an annual report has got multiple sections. It has got a director's report, it has got management discussion analysis, it has got data, it has got 5 years data, 10 years data, and there are multiple information in that. You are required to read them to ensure that there is no inconsistency between what is mentioned there and what has been considered by you when you gave your audit opinion. This essay requires auditor to read other content to ensure its consistency with the financial statements. Other information in the context of these standards and the auditor's report is the financial and non-financial information other than financial statements and auditor's report. So financial statement and auditor's report are not part of other information because they are your report. So you have an audit report and you have financial statement which are attached to the audit report. Apart from that, what is the other information in the annual report? So you specifically mentioned also that other information does not include my balance sheet because that is the primary thing. Apart from my audit report and financial statement, the other information on is what I'm commenting upon. The objective of the auditor, having read the other information, is to consider whether there is any material inconsistency between the FS and other information, to consider whether any material inconsistency within the other information and auditor's knowledge obtained during the audit, to respond appropriately if there is any material inconsistency, and to report in accordance with the essay. So this is your objective under essay 720. So what does the auditor need to do? Determine what all constitute the other information. This is necessary as the auditor needs to mention in the auditor's report. Read all other information, whether in director's report, management discussion analysis, figures in the said other report to ensure they are consistent with the data obtained while concluding the audit and that the figures match the ones in the financial statement or the schedules, including the profit figures, turnover figures in the director's report, that you need to ensure that the figures are correct. You need to ensure that what is reported is correct because there cannot be any inconsistency. They may do it in a short format, but when they talk of turnover, when they talk of profit before tax, when they talk of profit after tax, when they talk of provision for tax, those numbers should tally with your audited financial statements on which you have issued an opinion. While reading, the auditor has to be alert that it does not convey any meaning materially inconsistent with what the financial statement conveys. It is not necessary that every figure arising from the FS and sometimes breakups can be given in the other information, so long as they are not inconsistent with the records maintained by the company and which has been subjected to audit. The auditor is not certifying the figures, and therefore one needs to ensure that materially nothing is inconsistent. Discuss with the management whether the inconsistency exists in other information or financial statements. Basis that necessary correction may be insisted by the auditor to be done by the management. Typically, you ask for the other information before you sign the audit report. But many times, management discussion analysis and the director's report is adopted in the next board meeting. So they say that it is not ready as yet. So you will mention that in your auditor's report. If the management refuses to correct the inconsistency, then the auditor needs to take it up with those charged with governance. And here we're distinguishing the management being the operating team and those charged with governance, the board of directors. If the other information is not corrected, then the auditor needs to take appropriate action by either modifying the auditor's report relating to the paragraph on other information or withdrawing from the engagement if withdrawal is an option. If the auditor receives other information after the date of the auditor's report and material inconsistency is not corrected, the auditor needs to take appropriate action to bring it out to the attention of the user for whom the auditor's report is prepared. So in such circumstances, you may need to take some legal advice and probably speak in the annual general meeting saying this, that there is inconsistency because I could not correct this inconsistency because I came to know of it after my audit report was issued. And therefore, I want to bring this inconsistency to the attention of the members of the company, shareholders of the company. Reporting. The auditor's report must contain a section titled Other Information. This section will be placed before the paragraph on management responsibility for the financial statement. Typically, the auditor mentions the following in this section. The auditor has obtained or expects to obtain the other information. If part of the information, then identification of the part which is received. Mention what is included in other information that the financial statement and the auditor's report is not part of the other information. The other information is the responsibility of the management. The auditor's report does not cover the other information. So my report is only on the financial statement and not on the other information. Where the information is received before the date of the report and there exists an uncorrected material inconsistency, then clearly mention the portion which is materially inconsistent or is a misstatement. So if supposing they give you a draft director's report and they refuse to correct the draft director's report, then you will modify your audit report by including such inconsistency in the other information paragraph. I have not seen any such inconsistency being reported till date because most of the time these are corrected and it seldom happens that there is a disconnect between the other information and the auditor's report, but it is not an impossibility. And therefore, you have to read and understand your responsibilities and your obligation under this standard. Or mention that there is nothing to report if no material inconsistency is identified. In case of listed entity, the auditor is required to mandatorily obtain the other information, ensure its consistency with basis of preparation. This is even if the other information not obtained in full or in part before the date of the audit report. So even if they make the annual report afterwards and they present you afterwards, you are mandatorily required to cover it and ensure that there is no material inconsistency. If there is, then you need to tell them to correct it. And if they do not, as I said, then you have a challenge because you need to take it up legally with the company and tell them that I may be required to represent this matter in the annual general meeting. So in the annual general meeting, you may have to stand up and say that there is inconsistency in the other information, in the auditor's information, the reasons thereof, what you would have reported in your other information paragraph, you will stand up and talk about it. Therefore, the auditor is required to maintain continuous follow-up for the other information and ensure that it is read before the date of the annual general meeting. In the case of the unlisted company, the auditor has not received a part or full of the other information. The auditor is only required to mention the fact that the other information is expected to mention that the other information will be made available after the date of the report. This standard does not cast an obligation to follow up the other information in the case of unlisted entities. Now, once again, I will quickly take you to Infosys report to show you the other information paragraph. So after we read the CAM, we have information other than the financial and statements and auditor's report. So just read quickly. It's a small paragraph. The company's board of directors is responsible for the other information. This was there in my presentation that you have to mention it is responsibility of the board of directors. The other information comprises the information included in the management discussion. So what all is other information? Management discuss analysis, board's report, including annexes to board's report, BRSR report, business responsibility and sustainability report, corporate governance report, shareholders information, but does not include the consolidated financial statement, standalone financial statement, and our reports thereon. So we are, to be very clear, our opinion does not cover other information, which is there in the next line. Our opinion on the standalone financial statement does not cover the other information. We do not express any form of assurance conclusion thereon. In connection with our audit of the standalone financial statement, our responsibility is read the other information and in doing so, consider whether the other information is materially inconsistent with the standalone financial statement or our knowledge obtained during the course of our audit or otherwise appears to be materially misstated. If based on the work we have performed, we conclude there is a material misstatement, we are required to report that fact over here. We have nothing to report, means there is no inconsistency. Now, let's take an example where they refused to correct the inconsistency. You have issued this report and this information came to you afterwards. Then you will stand up and say in the AGM, what was the material inconsistency? If the other information was given to you before and then they refuse to correct the other information because they have a difference of opinion, then you will report what according to you the material inconsistency in this paragraph below this section. So before we go to CARO, if there are any questions on 701 and 720, I'll be happy to answer them. After that, I'll quickly touch upon CARO.
Students, if you have any query on 701, please ask. Sir, Anil is asking, why the auditor bothered about other information if the report not covers about other information?
Right. So let me answer this. So it's a good question. See, shareholders reading other information, right? He forms an opinion or he understands something from the other information. Your auditor's report and the financial statements gives a different position of that other information, and there is an inconsistency. So the inconsistency will be such that the shareholder will think कि financial statement सही है, कि auditor's report सही है, या with other information सही है, and therefore you have formed an opinion on the basis of the information given to you and your understanding of the financial statement and of the business when you gave your opinion. Well, let me give a simple example. When you were doing the audit, the company had investment in some subsidiaries. You asked them questions on impairment, and they said that no, this is the beginning portion, and the losses are only because it's a startup venture, and we will convert ourselves into profit, and long-term benefit is there in the company. Therefore, we do not want to do any impairment, and therefore we will not take a hit on the profit and loss account. This is what was told to you. Basis that you took some working and you concluded that no impairment is required, and you did not qualify the report. Now, in the director's report, they're saying that the subsidiary is struggling to do business and its substantial value has eroded, and the company needs to take cognizance of the subsidiary's bad functioning, etc. So there is an inconsistency. They told you that this is temporary and long-term benefit is there when you were doing the audit. Now they want to come clean before their shareholders and say that there is a trouble in your subsidiary. So this is materially inconsistent between what was told to you when you were doing the audit, because they did not want to take a hit on the profit and loss account. But they also wanted to be clean and clear before the shareholders, and they told what are the problems to the shareholders by way of directors report or management risk analysis. So they have taken two stands with respect to the subsidiary. Now somebody can question, then why did you not do the impairment, right? A regulator can come back to you and saying that why did you not do impairment, because the regulator will also read the other information and say, अरे ऐसा है तो तुमने impairment क्यों नहीं किया? What will you answer at that point of time? How will you give, what is your defense at that point of time? Therefore, reading other information is necessary, and ensuring its consistency is required only because that it may affect on the quality of your work. To justify your quality of work was not incorrect, you need to read so that there is nothing mentioned in other information which may cast doubt on the quality of work that you have done. And Ankita, any other question, or I can
No,
move
sir,
to?
that was it.
Yeah, so I'll go to CARO now.
Yeah.
So this is my detailed presentation on CARO 2020. CARO is a report where there is subjective reporting on certain questions which are asked. And CARO has a very old history, because during the time when I was studying, which is almost 30-40 years back, we had something called MAO CARO, Manufacturing and Other Companies Auditors Report. Later on, they dropped the MAO and made it only CARO, and they call it Companies Auditors Report Order. So after MAO, we had CARO 2014 or 15, then we had 16, and after that we had CARO 2020. So CARO 2020 has substantially updated the reporting requirement. This was issued just before COVID attacked us. Although it's called CARO 2020, it became applicable for all financial statements beginning on or after 1st April 21 because of continuous extension being given to it. So 1921 couldn't do it, 2021 we couldn't do it because of COVID, and it came into play from 21-22. With the number of companies under the cloud of corporate fraud and scam, the Ministry of Corporate Affairs has further enhanced the role of auditors. By this notification dated February 20, 2020, issued CARO 2020 in supersession of the existing Companies Auditors Report 2016. Deferment of applicability. Applicability of CARO deferred for audits for 21-22 and onwards. Thus, CARO is applicable for all financial beginning from 1st April 21. As I said, because of COVID, it was not applicable for 1920. It was extended for one more year for 2021, and it became applicable for periods beginning from 1/21/22, because by April or May 21, substantially we had covered ourselves out of COVID and most of us were vaccinated and things started looking better. Enhanced management responsibility, as more information and advanced planning is required, setting up of systems and internal control is required. Timely reporting, aggregate and compile information for audits on a timely basis. This is the background on the basis of which CARO 2020 was issued. What was the purpose of changes? Last minute auditors resignation. Evergreening of loans. So what is evergreening of loans? A particular loan is due next month. To ensure that they pay me on time and I don't have to make a provision against it, I give a new loan so that from that money they pay my old loan back. So that is called evergreening. So then there is never a bad debt, because every time a money is due, I give them a new loan. Or money used for other purposes. We know there were a number of cases where money was siphoned off or used for purposes other than for which they were lent to the company. Going concern issues were rampant. Corporate social responsibility was, there were a lot of shortcomings in their compilation of corporate social responsibility. Strengthening the role of internal auditors, loans and advances to related party, and whistleblower complaints and fraud reporting. These were all the purpose for the changes in CARO 2020. So there is no change to the applicability, applicable to every company, including foreign company, except banking, insurance, Section 8 company, 1% company, small company, private company within the threshold. There is no change to the threshold also. Order not applicable to investment trust, REIT governed by SEBI infrastructure investment trust regulation. It is applicable for branch audits too, including foreign branches. It's not applicable to CFS for clause by clause reporting, but there is a separate clause 21 for summarized reporting of adverse or qualified remarks under CARO for the company included in the CFS. I will touch upon that. So this is the broad overview. 7 new clauses were added. 10 of them were modified. Total were 21, and there was one which is deleted. Subsection wise, there were 26 newly added, modified were 12, and the total changes were 46 and one was deleted. Now, what are the matters to be included in CARO 2020? Three, 1A, B, C, D, E, maintaining records of property, plant, and equipment. This has been modified. Physical verification inventories, there's some modification to this. 3, A, B, C, D, E, F relates with investment guarantee securities and loans granted by the company. There are modification to it. Compliance of 185, 186, there is no change. Acceptance of deposit, there is minor modification. Cost records, there is no change. Statutory dues, minor modification. Disclosure of transaction not recorded in the books, this is newly added. Clause 3.9 A, B, C, D, E, F, default in repayment of loan and other reporting requirements, there's been modification. 10 A and B, money raised by IPO, there is minor modification. Fraud reporting, modified. Compliances by Nidhi company, modified. Transaction with related party, no change. Internal audit system, newly added, because CARO 2016 did not have any reporting on internal audit. No non-cash transaction with directors, no change. Registration with Reserve Bank of India, modified. Cash losses, newly added. Resignation of auditors during the year, newly added. Capability of company meeting its liabilities existing at the date of balance sheet, this is newly added. Transfer of amount remaining unspent, this is newly added. Consolidated financial statement, this is newly added. So these were the set of changes which was done in CARO 2020 vis-a-vis CARO 2016. Reporting of managerial remuneration under 197 has been deleted because it is already covered in my main audit report. So it was a kind of a duplication, so they have deleted that. Now, let's look at clause by clause analysis of the order. 3.1A and B. This clause has two subparts. The section deals with PPE for maintenance of details of PPE has not undergone any change. However, that the clause has now covered ROU assets also acquired under finance lease post application of India's 116 leases. A new subclause B has been introduced for maintenance of proper records showing full particulars of intangible assets. This is the modification that intangible asset records also are to be kept. So even if you have some intangible assets, you're supposed to have an asset register maintaining details of the type of intangible asset, documentation supporting the ownership, economic life, amortization policy, acquisition cost, yearly amortization, and the net carrying value. 3.1B is the same as the previous CARO relating to system of physical verification. 3.1C deals with title deeds. However, the words in the set clause says all immovable property disclosed in the financial statement. However, the guidance note has clarified that it extends only to those shown as PPE. So when they said all immovable properties, so in case of a real estate developer who shows immovable properties as part of his inventory, there were some questions whether we have to cover them also. Then the guidance note came and clarified that it extends only to those shown as a PPE. The clause also provides the disclosure of immovable property not being in the name of the company to be made in a specified table form. So this table form I have addressed in the next slides. So there is a specific exclusion of property where the company is the lessee and the lease agreements are duly executed in favor of the lessee. Further, same is required only for those immovable properties which are disclosed in the FS. Therefore, the cancelable leave and license are not required to be covered here. Clause 3(1)(d) has been introduced relating to reporting on revaluation of PPE. So revaluation can be done only by entity who follow the revaluation model. So gone are the days when somebody could do a one-time revaluation and enhance the value of their assets and carry something called a revaluation reserve. Now revaluation is possible only for somebody who follows the revaluation model, which means that year after year, he has to have a revaluation report and he has to make adjustment to the revaluation year after year. If you follow that model, then whether the revaluation was done on the basis of report of a registered valuer and the amount of change the value, if the change is greater than 10, then the net carrying value of each of those class where the change is more than 10% has to be disclosed in your report. 3(1)(e) is new, relating to Benami. Supposing the company has received a notice for Benami holdings, then the management needs to include any notice issued under this act in its minutes and discuss the same. It is brought to the notice of auditors to use a judgment if any disclosure required. So if there are any proceeding initiated or pending, the auditor needs to report whether appropriate details are disclosed in the financial statements under the Benami Transaction Prohibition Act. So if there has been a Benami transaction notice issued, then auditors need to look at it and appropriately address those things in under 3(1)(e) of the auditor's report. 3(2)(a), there's a minor modification. This clause is related to physical verification of inventory and appropriate effects of a discrepancy have been taken or not. The new clause has been defined that the maturity level is at 10%. Therefore, if there are differences of 10% or more in the aggregate of each class of inventory, then the fact thereof and whether the same have been properly dealt with has to be reported. So wherever there's a difference of more than 10% in a class of inventory, say example, raw material, packing material, finished goods or WIP, then you need to report the amount of shortage and excess and how you have dealt with it. Further, the new CARO also requires the auditor to opine whether the coverage and procedures of physical verification by the management is appropriate. 3(2)(b). This is new. This is a new clause introduced relating to compliances in connection with the sanctioned working capital limits in excess of 5 crores from banks. So what happened is that the reason for this was that many companies gave statements to the bankers to have a better drawing power. These statements to the banks were generally found to be not consistent with the figures in their balance in the books of accounts. Therefore, to ensure that nobody has given a statement to the bank for drawing power, which is not in consistency with the books of accounts, the auditor is required to mention them over here. So only secured limit to be added to check limit of 5 crores and reporting under this clause. Unsecured limits do not form part of this clause. Working capital secured by other than current asset need not be considered over here. The auditor is required to report whether the quarterly return. So they may file monthly statements to the banks. We are required to see only the quarterly. So we have to check whether the June, September, December, and March figures which have been filed with the bank are consistent with the books of accounts. For the purpose, the company is required to maintain a complete trial of how the data is prepared, complete trail of how the data is prepared for submission to the bank and is trailed to the balance sheet and books of accounts. So the company needs to have a working sheet to show how from the cost records, inventory records to balance sheet, everything has been set. So inventory may or may not be there in the balance sheet, but it will be there in the stock record. So you have to make sure that the stock figures, the inventory figures are consistent with the books of accounts, which has been reported to the bankers. Where there are book debts, whether the data of book debt is tallying with the debtor shown in the balance sheet in the books of accounts or not. If there is a difference, then he has to show the differences and he has to report on the differences. So there cannot be any out of book adjustment and every data has to be compared with the books of accounts. Although the GN states the auditor need not do audit of the figures, only trace them to see if they are properly extracted, necessary diligence will be done by the audit team. As mentioned in Schedule 3, the company also needs to disclose the differences between statement filed with the lenders and books of account, reconcile the same and give reasons for differences. So many times the company may file where there is a quarterly audit, a quarterly limited review. The company may file because they are required to file by 21st of the month or 15th of the month based on the sanction note. They may file, and the difference may be on account of audit adjustment done during the course of audit. So generally, the company then discloses that this is on account of audit adjustments, and then they file a fresh statement with the bank to tell them that pursuant to audit, this is how we have dealt with it. Most of the bank also requires filing of a form called FFR1 on a quarterly basis and FFR2 on a half-yearly basis. This is apart from the stock and debtor statement. These are information on financial information from the unaudited financial statement like turnover, current assets, etc. If the sanction requires this information, then the auditor will review this information also and comment on the correctness of this information. The non-filing also are to required to be reported, else the same would amount to stating that everything is properly filed. So if supposing a company has a sanction limit and it is required to file, but it is not filing, so you have to mention in your report that although it is required to file, it has not filed any of these statements to the bankers. Clause 3 within bracket 3A, major modification. There are a large number of disclosures related to investment and loans and advances, provided guarantee given and securities provided. The auditor is required to report the aggregate amount of loans provided during the year without adjusting any subsequent settlement and balance outstanding as of the balance sheet date under clause 3(3)(a) big A. The auditor is required to report the aggregate amount of loan provided during the year and balance outstanding under clause 3(3)(a) big B. As per GN, the balance outstanding at the end of the year are only out of the loan granted during the year and not the earlier loans. The data will be required to be prepared by the company for factual accuracy, which the auditor will verify and include in the CARO report. The disclosure is given in the next slide. So in your audit report, you're supposed to give this table: details of loans, advances given, guarantees, loans and advances given, and amount outstanding at the end of the year, loans and advances to subsidiary joint venture associates, other than subsidiary joint venture associates, guarantees provided to subsidiary joint venture associates, other than subsidiary joint venture and associates. So here in this column, you'll give the amount given during the year, and here you'll give the amount outstanding out of the same during the year. Clause 3(3)(b) has a major modification. The auditor is required to report whether investment made, guarantees provided, securities given, and the terms and conditions, loans and advances granted are not prejudicial to the interest of the company. As per the guidance note, the same is to investment, loans, etc. granted during the year. The auditor will seek details of all investment made, securities given. Further, against each of the matter, the board noting for the rationale of investment or guarantees given, and whether the same is prejudicial to the interest of the company, is to be analyzed. The term sheet of all loans granted with the interest and repayment terms are to be tabulated against each of them, when the comments are to be captured. Wherever necessary, management representation is also to be taken on record. 3(3)(c) and 3(3)(d), minor modification. These clauses require auditors to report on the regularity of repayment of loans and advances. These clauses include the opening balance, unlike the earlier clauses. This clause is now applicable for all loans and not restricted to parties listed in section 189. The amount overdue is required to be disclosed whether the amounts are overdue for more than 90 days. The auditor is also required to report whether reasonable steps have been taken for recovery. Term sheet of all loans and their compliance to be part of the CARO documentation, and therefore it is advisable to ensure that the company has an updated term sheet for all the loans granted for CARO compliances. And the auditor is also required to ensure that they have verified these term sheets and report on the basis of these term sheets. 3(3)(e) is the new clause. This new clause requires reporting on evergreening of loans. So evergreening of loan can be in the nature of renewal. So supposing something is due on 31st of March, you renew it for one more year. So by virtue of which there is no default. You have rescheduled it, you have renewed it, you have restructured it, granted a new loan. All of these are evergreening. So therefore, it includes the opening balance of loan and advancing nature of loan. If there are such instances, then the aggregate amount of loans renewed, rescheduled, or fresh loans given, and the percentage of such loans to total loans granted is required to be reported. The company will have to prepare the disclosure if there are such instances for factual accuracy, which will be verified by the auditor and included in the auditor's report. This clause is not applicable to an NBFC. 3(3)(f) is a new clause. The auditor is required to report whether there are loans that have been granted without any stipulation for repayment, meaning that they are demand loans. There is no terms mentioned that you have to repay me back in 3 years' time or 4 years' time or 1 year's time or 2 years' time. So there are no stipulation mentioned in the loan. You just gave a loan without any stipulation. Then you are required to mention how much of the amount of such loans have been given without stipulation and what is the percentage of such loans compared to the total loans. Further, the aggregate of such loan granted to promoters related parties are also required to be disclosed. The suggested disclosure as per the guidance note is aggregate amount of loans, all parties, promoters, related party, repayable on demand. Agreement does not specify any terms or repayment. Total of A and B. Percentage of loans, advancing nature of loans to the total loan. So here is the percentage. You may be 60%, 30%. So for all parties, promoters and related parties is what is the suggested disclosure as per guidance note. Clause 3, 4 and 3, 6, there are no changes, but there is clause 3, 5, there are minor modification. These relate to compliance with section 185. There is no change in reporting. Similarly, the term deposit compliance did not undergo any change except that the term deemed deposit has been introduced. However, as auditors, we have always been considering deemed deposit also for compliances. There is no change in CARO reporting requirement for cost records maintenance as compared to CARO 16. So therefore, we will not discuss them. Guidance note explains what exactly is the reporting requirement. Clause 3.7, there are no changes, accepting that GST has been replaced with sales tax has been replaced with GST as a separate matter reported under clause 3337A. However, there is a change to reporting requirement related to disputed demands unpaid. Earlier, it was restricted to income tax or sales tax, service tax, or excise or VAT. Now it encompasses all the statutory dues covered by 37A, which is all encompassing, and therefore additionally now the disputed tax demand will get extended to all the statutory dues unpaid due to a dispute. Clause 3.8 is a new clause. The new CARO disclosure, whether there are any amounts that are not recorded in the books that have been surrendered or disclosed as income before the income tax department. So if there was a raid or there was some search or some survey, and on the basis of that, the company has disclosed some amount into the tax department on the basis of which they've agreed to pay tax, then basis your discussion with the management pursuant to the raid or search or survey, you will report that matter over here. This will also apply to any additions accepted during the course of assessment and on which no appeal has been filed. As discussed in the presentation on Schedule 3, the management also needs to make such the disclosure. Our comments will be in line with the disclosure made subject to verification of information. If so, then the auditor needs to comment whether they have been properly recorded in the financial statements. We will need confirmation of the tax advisor's representative in writing about the same, along with copies of latest assessment orders. This may not necessarily be an outcome of search or survey. As I said, even normal assessment, if you have agreed to an addition and agreed that you will not dispute it, that will also get covered for disclosure under 3.8. But the key factor that it should be surrender, not recorded. So if there is an addition during normal assessment, you filed an appeal against it, no reporting requirement is required over here. 39A, there's minor modification. 39 primarily deals with loan taken from banks and related issues. 39A deals with default in repayment of loans and other borrowings, and specifically mentioned that default in repayment of interest also is to be reported. The format also provide the clause also provides a table format for reporting, and the default is to be mandatory update in the table format. The next slide, I will show you how the table format is this. Further, this covers all lenders and does not restrict itself to banks or financial institutions. So even if you do a private lending and there's a default, you need to report it over here. So this is the format: nature of borrowing, name of the lender, amount not paid on due date, whether principal or interest, number of days delay, and remarks, if any. This is the formats I've suggested in the CARO report itself. 39B is a new clause. This clause requires the auditor to state whether the company has been declared as a willful defaulter by any bank or financial institution. So this is the onerous responsibility. So there are two ways to handle this. One is you take a written representation that they have not been declared, they have not received any notice for a willful defaulter from any banks. Generally, this will happen if you are an NPA and if you have defaulted in repayment to a bank. If you have not defaulted in the repayment of bank, you generally will not get covered over here unless you have some past legacy issues for which they have issued the notice now. Willful default need to be reported till the date of signing a financial statement. Therefore, the subsequent events taken into consideration also are to be taken for reporting requirement. If possible, the auditor may write to the lead banker requesting their confirmation for which necessary facilitation by the management may be required. You may also do a Google because RBI generally releases a list of willful defaulters and therefore search whether your company, your auditee's name is there in that or not. 39C, there are minor modification to this. This clause is similar to what was always required for the term loan application of funds drawn. The only difference is the word diversion is used considering various cases of diversion of funds noted by banks forensic audit. So earlier the clause was whether there has been the company has applied that loan to the for the purpose of which they were drawn. Now the word diversion have also come into the clause. So therefore diversion of funds is also equally to be checked up. This reporting requirement is also part of changes to Schedule 3, where company also needs to make categorically assertion of the application of funds and diversion of funds in the financial statements. If any misapplication is noted, then full detail will be necessary to be included in the reporting. Clause 39D is a new clause. This is for short-term funds applied for long-term purposes. So as I said, CARO has an old history. This was part of CARO 2003, which got replaced by CARO 2016, 15 and 16. So in that, this was dropped. But in CARO 2003, which I think replaced Mao CARO, this was there, where the short-term funds are applied for long-term purposes and vice versa was also there. So both of them were required to be reported. So, but in this one, it is only short-term funds for long-term purposes. So, Schedule 3 requires disclosure of current and non-current assets, current and non-current liabilities. Therefore, where the current assets minus current liabilities reflect a negative figure, the reporting under this clause could get triggered and needs to be examined for reporting. The only adjustment would be the figure of current maturity for long-term liabilities. The GN confirms that it is not funds raised on short-term basis. So, therefore, you will do current assets minus current liabilities. If it is negative, after adjusting the inclusion of current maturities of long-term funds, then you have a triggering issue for reporting under this clause. There is no clarity for the amount of permanent working capital. Therefore, if the figure is negative, then further exercise needs to be done to determine the amount of permanent working capital finance. 39E is a new clause. This is entirely new reporting requirement. It deals with loans taken for meeting the obligation of the subsidiary, joint ventures, or associates. So if you have taken a loan specifically for the purpose of meeting the obligation of a subsidiary, joint venture, associate, then you need to mention whether you have taken any loans and for the purpose of meeting the obligation of subsidiary, joint venture, or associates. And accordingly, you have to report over here. Board minutes, terms of the loan sanction needs to be verified, provided and verified, and that will give you the triggering point why this loan was taken. So, for example, if I have taken a loan for meeting the requirement of one of my subsidiaries problems, then the term sheet will definitely mention, because otherwise it will not allow me to divert the money from my bank account to the subsidiary's bank account. And therefore, seeing that term sheet, my auditor will then mention that this term loan was taken for the purpose of meeting the subsidiary's requirement. This clause requires the auditor to report on whether the company has obtained loan on the pledge of securities of its subsidiary, JV, or associates. So, quickly to tell you, there could be instances where I have a valuable investment in a subsidiary. For example, I may have shares of a subsidiary which is listed. If I take a loan on the basis of security, pledge of security of that subsidiary, then that loan, the terms of the loan, the details of the loan are to be reported under this clause. This clause only applies to loans taken during the year. Just a minute, please. The CARO report is going to become bulk inclusion various tables and data which are not otherwise in the financial statement. Once again, this data must be prepared by the company for factual accuracy, and we as auditors will be only verifying and including the audit report. So, if there is any loan taken by pledging the shares of a subsidiary, joint venture, or associates, then the details of such loan are to be given in the CARO report. The guidance note has provided a format for the disclosure of the information, and it is advisable to follow that format. So guidance note has provided a format: nature of loan taken, name of the lender, amount of loan, name of the subsidiary joint venture, relationship, details of security pledged, and any remarks, if any. In remarks, you may write the purpose for which the loan was taken. Then clause 310A and clause 310B, there are modification to that. Clause 310A and 310B were also there in 2016 CARO. They primarily deal with any money raised for IPO or private placement purposes. So it has been extended to rights issue also, apart from preferential under section 42. The report requirements similar, whether the same have been applied for the purpose for it was raised, and in default and complying with the same. So therefore, typically, till the loan is applied for, the financial statement will have a table which will state that this much funds were raised, this much is applied, and this much is kept in bank balances. So in your report, you can make a reference to that table and say that they have been applied as per the details provided in note number so and so of the financial statements. As auditors, it is advisable to get a secretarial compliance certificate well in time to enable us to comment on the same. The auditor is also required to report on the utilization of the amounts raised. If the entire amount is not spent in the year, then this reporting would continue in the following year till the entire proceeds are utilized. So, supposing I did a rights issue or I did a preferential issue of 1,000 crores, and I applied 600 crores in the current year, 400 crores in the bank. My obligation doesn't get over in this year of 25-26. I will have to report in 26-27 or even 27-28 till the balance 400 crores is also applied and the balance unapplied portion is zero. Clause 311. Clause 311 has some minor modification. This relates to fraud reporting, but it has now three subclauses. The first subclause is that requirement of fraud on the company was done specifically by employees and officers have been done away. Now, all frauds by the company or on the company by anyone is required to report it. For example, if there's a fraud done by a non-employee, earlier the fraud done on the company by employee or officers was there. Now, fraud on the company or fraud by the company, irrespective of who has done it, is required to be reported over here. Therefore, there's a fraud of money due to hacking of a bank account or phishing or transaction fraud or digital fraud, then the reporting would be required under this clause also because it's a fraud, because he sent you wrong information and fraudulently misrepresented and you paid this money. So therefore, those will also get covered for reporting. Earlier, it was done only if the phishing or fraud was done by the employee or officer. Now it applies to everybody. Further, the auditor is required to give details of any filing done in Form ADT4 by the auditor. So ADT4 is to be done under 143.12. If there is any fraud brought to the attention of the auditor and if the amount of fraud is in excess of 1 crore, then there is a reporting format ADT4 which is to be done to the Ministry of Corporate Affairs directly by the auditor. So this has also been brought in over here, that obligation, whether there was a fraud and whether you have done any reporting, is to be mentioned in your auditor's report so that the reader of financial statement also is aware of it, because MCA knows it, he may not know about it. So now that is also brought over here. Under the last subclause, the new CARO requires auditor to look into whistleblower complaints. The auditor therefore would need to know whether the company has a whistleblower mechanism in place and whether they have received any complaints under the mechanism. The confirmation to this effect from the audit committee and the company secretary would be required. So you will generally, the whistleblower complaint comes to the audit committee and the company secretary. So you will look at the minutes of the whistleblower committee or minutes of the audit committee and see whether any whistleblower complaints have been brought to the attention and how they have been dealt with. So if the provision whistleblower is applicable to the company, then the minutes and proceeding of such are to be scrutinized. Even if the company has followed voluntary compliances, then also reporting will be required because they have a whistleblower mechanism. So if supposing whistleblower was not applicable to the company, but they have voluntarily decided to have a whistleblower mechanism, then also reporting requirement will be triggered under this subclause. Clause 312, there are minor changes. This relates to reporting in respect of Nidhi companies. So wherever the company has, where the company is a Nidhi company, there are some reporting requirements. It is similar to what is mentioned earlier, except that there's an additional reporting requirement of reporting on default in the payment of interest and principal prepayment of deposit by a Nidhi company. Once again, the report is additionally required over and above the reporting clause 39A. So in 39A also default is required. Here also you need to mention. You may cross-reference the two of them, but you cannot ignore reporting over here just because you have already reported the 39A. Clause 313, there are no changes. This deals with compliance section 177 and 180 and is similar to the report requirement of CARO 16, where you are supposed to mention whether the provisions of section 177 and 180 have been complied with and whether the disclosure of related party transaction as applicable under respective accounting standard has been done in the financial statement or not. So this the auditor is required to report on, and this does not change as compared to CARO 2016. Clause 314 is a new clause. Clause 314 is in respect of reporting on internal audit. This was there in CARO 2003. Now it has got reintroduced. It was missed out in CARO 16. Now it has got reintroduced. And the auditor is required to mention whether the internal audit system is commensurate to the size and nature of business. This was there in the 2003 reporting also. Additionally, now the auditor is also required to report if the report have been considered while finalizing the audit report. So if the internal auditor has mentioned some shortcomings in the internal controls, you cannot ignore that because you will have to take them into cognizance when you're reporting on your internal financial control reporting. And therefore, you have to ensure that not only do you mention that the internal auditor report is internal audit is commensurate, you have to make sure that all reports are read by you and all effects which are required in the financial statement pursuant to the internal auditor's report are taken into consideration. So you have to ensure the company places all internal audit reports to you and every report is scrutinized by you. And on the basis of that, if any effects are to be taken, you have taken those effects. If any audit is done but the report is not finalized, then the auditor will need to report the non-reserve report and therefore the same has not been considered while finalizing the audit report. That also is required. For example, many times the internal auditor doesn't finish the work in time and his report is not finalized. So you cannot say that it's commensurate and I have received all the reports. You will have to mention that based on the reports received, it is commensurate. However, the final report for the last phase or third phase or fourth phase are not yet received by us and therefore have not been considered by the auditor at the time of issuing this report. Clause 315, there is no change, deals with non-cash transaction entered into with the directors and person connected with. This is similar to the clause 315 in CARO 2016 also, therefore does not need further elucidation. Clause 316, there are modifications. This clause relates to RBI registration requirement and has 4 subclauses. So you see, under RBI rules, if a company's total financial income is more than 50% of the total income, and if his total financial assets are more than 50% of total assets, then he's deemed to be carrying on NBFC activity. So therefore, as an auditor of that company, he may not be registered, but his income from financial activity is more than 50% of total income and his assets, financial assets are more than 50% of total assets. So he, by virtue of this conduct, becomes a non-banking financial company, and since he is not registered, he is not coming under the purview of RBI scrutiny. As an auditor, you are required to inform the RBI when you are the auditor of such a company who meets the NBFC main activity requirement, but is not registered. So the first clause similar to the clause relating to company carrying on NBFC activity without registration. The second subclause relates to companies carrying on NBFC activity, housing finance activity without a valid certificate of registration. The third subclause deals with CIC companies, saying that if you are a CIC, then you may not need registration, but you need to mention that fact based on the calculation. This clause requires the auditor to report whether any company which claims itself to be CIC is actually complying with the provision of CIC. And the last subclause requires to mention if the company is a CIC, whether it satisfies the exemption or non-registration requirement of RBI, and the number of other CICs in the group. So the reporting for such activities become onerous. The company auditor needs to ensure that all the data is made available to him. He finds out which are other companies in the same group and make sure that none of them are a CIC, none of them carry a CIC registration or are a deemed CIC. Necessary management representation is required from them, and basis that this reporting is to be done. The CIC test in brief is it holds not less than 90% of its assets in the form of investment in equity shares, preference share bonds of group companies, of which 60% should be in equity investments. Does not trade in shares or of its company in the group except through block sale. Does not carry any other financial activity except investment in bank deposit, money market investment, including liquid mutual funds, government securities, and issues guarantees to group companies. So even the 10% can only be in bank deposit, money market investments, or government securities, and cannot be in the shares of other companies. Then only you will be a CIC. Meaning of the group is, company in the group means an arrangement involving two or more entities related to each other in the following relationship: subsidiary parent, joint venture, associate, promoter, promotee, for listed companies, related party as per AS18, common brand name, invest in equity shares of 20% or more. All of them fall into the definition of group. And here the company in the group is to be followed as per the RBI definition, not by any company in that definition. Clause 317 is a new clause. This clause requires the auditor to mention if the company has incurred cash loss in the current year and previous year. This was there in the old CARO 2003 and somehow did not find a place in CARO 2016. This has been brought back in CARO 2020. Cash loss is not defined in the Act or the accounting standard. As per the guidance note, cash loss means in order to determine the amount of cash loss financial year, figure of profit and loss shown by the profit and loss is adjusted for the effects of transaction of a non-cash nature such as depreciation, amortization, deferred tax expenses, or any write-offs. So these are non-cash transactions, and you have to make an adjustment to that and then conclude whether the company has made a cash loss or not. The working are also required to adjust for effects of any qualification which may affect the determination of cash losses. In the case of India's company, whether the India's adjustment are required to be adjusted is also going to be a challenge, and we need some deliberation to see whether the India's adjustments are actually a cash adjustment or a non-cash adjustment. As I mentioned in my opening slide, CARO 2020 has come into play only because of certain resignation of auditors. So people were resigning auditors and new auditors were coming in. So this clause deals with a situation where pursuant to resignation, a new auditor has been appointed. This clause requires the auditor to comment upon whether the auditor has taken into consideration the issues, objections, or concerns raised by the outgoing auditor. Where we have been appointed after resignation of auditor, we are required to comply with the reporting here. If the auditors resign without citing any reason which affects the financial statement, then the same are also to be mentioned as such in your report. 319, this is a new clause and it's a quite a detailed clause. You are supposed to report whether you are capable or whether the company is capable of repaying all the short-term obligation as and when they fall due. The auditor is required to opine that no material uncertainty exists as of the date of the audit, that company is capable of meeting its liability existing at the date of the audit. If the current assets are far in excess of current liability, reporting in the clause will not be challenged. However, it will be challenged the current liabilities are in excess of current assets. The guidance note says the auditor will categorically give a statement that the report does not guarantee that the payment will be made. That's what you are only opining whether the company is capable of paying, but you are not guaranteeing that the company will pay, and therefore your report should categorically state that this does not mean that we are guaranteeing that the amount will be paid on the due date. For this purpose, the cash flow statement for next 12 months are required to be taken, business plans of company, detailed plans of fresh borrowings or capex, which will require utilization of current resources. So you need to make sure where you have made a material uncertainty related going concern paragraph, then the reporting under this clause will also have to have a cross reference to that paragraph. You cannot make a material uncertainty going concern paragraph in the initial portion and then here you mention a clean report. You have to make sure that the two of them are cross referenced properly. This clause relates to reporting for CSR compliances, whether the unspent amount of CSR expenditure on ongoing project at the end of the year have been transferred to special accounts, and when the unspent amount relates to other than ongoing project, whether the same have been transferred to a fund specified within a period of 6 months. So additionally, these are obligation of the management. The auditor is required to now mention whether they have done their obligation and whether the amount has been set aside or whether the amount has been paid to the fund within a period of 6 months. There's a detailed disclosure guidance from the MC and the IC on the disclosure requirement. The MC recently issued a circular which supersedes all previous circular on the subject of CSR. The last clause is for CFS. So in this clause, all entities which form part of the CFS may be a subsidiary, associate, joint venture, or include and the holding company. If in the CARO of those companies there is any negative or adverse report, then you are required to mention that in under this clause in the audit report for the CFS. There will be only one clause in the audit report of CFS for CARO, and that will be this clause. Auditors required to report here the clauses where there are adverse or qualified remarks under the CARO paragraph, each of the companies, including the CFS. This would need a tabular reporting of adverse or qualified remarks arising from the holding company and also the company included. Even JV and associate are to be included if CARO is applicable to them. Therefore, all signed CARO reports are required before we finalize the CFS audit report. The biggest challenge is to determine what is adverse and qualified remarks and what is only information. So this is how you will report that XYZ Limited is the parent, audit report dated, clause so-and-so of CARO 20 reported by para in the CARO section. So where the adverse remarks are given. So this is how you will mention in your CARO report of the consolidated financial statements. So this was all about the CARO. Changes. Ankita, any
Students, if you
queries?
have any query, you can ask. Students, you can ask if you have any query. No query, sir. We can proceed.
Okay. So now I'll take up a few case studies like the other day. So case study 1, I'll read out the case study to you all. An infra holding company Holdco Limited is in the business of operating BOT projects having 10 SPVs in various states of the country, which are either in construction phase or operating phase, collecting tolls. On account of the COVID pandemic, the entire business has come to a standstill for a period of 6 months where neither construction nor the toll collection were in progress. The government and the central bank have not made any relaxation for the pandemic due to the difficult fiscal situation. However, the government relented finally and stated that it will consider giving compensation based on a formula decided by them. The auditor sought the details of the possible impairment and the going concern assumption of all the 10 SPVs. The management made detailed calculation, shared the same with the auditors along with the relevant clauses of the concession agreement and the formula of compensation of the government. Basis this detailed working, which the company shared on which considerable audit time was spent, the auditors concluded after spending considerable time that impairment provision is not required and also that basis this the going concern assumption was also intact. The company is a listed company. As an auditor, how will you address these issues while framing your audit opinion? So typically, this is a situation which many people had a problem during pandemic, and the government gave concession. You did technical concessions. You were making losses. Things that come to a standstill. You were waiting for government's compensation, etc. So the auditor has spent considerable time in understanding whether I need to do any impairment, whether I need to do any permanent loss provision, or whether my going concern is intact or not. So this is a classic example where the auditor has spent considerable time, and this was a key audit matter for the auditor for reporting in that period. So therefore, this is a case study for reporting under CAM. So how did the auditor report under CAM? SA 701 deals with auditors' responsibility to communicate key audit matter in the auditor's report. The purpose of communicating key audit matter is to enhance the communicative value of the auditor's report by providing greater transparency about the audit that was performed. Communicating key audit matter provides additional information to intended users of the financial statement to assist them in understanding those matters that in the auditor's professional judgment were of most significance in the audit of the financial statement of the current period. Areas of significant audit attention often relate to matters of complex and significant management judgment. The auditor may communicate these with those charged with governance, discussing the plan, scope, and timing of the audit. However, the auditor determines key audit matters based on the results of the audit or evidence obtained. In the given case, the business of Holdco Limited has come to a standstill for 6 months due to COVID pandemic, which might result into possible impairment and affect the going concern assumption. The same has been communicated to management. Management made detailed working based on concession provided, formula of compensation decided by the government. The auditor also has spent considerable time on the calculation submitted by the management and concluded that the impairment provision is not required. Also, that basis this the going concern assumption is also intact. The auditor should consider this matter as a key audit matter and disclose the auditor's report by giving cross-reference to the disclosure in the financial statements. So how did he report this? As of 31st March 2020, carrying value of intangible asset development rupees dash and dash. The group and its SV have toll collection rights as intangible assets. The carrying value of these rights acquired under BOT basis is being compared to the recoverable amount, which is value in use. The process involves estimating the value of in use of the asset, which is determined by forecasting and discounting future cash flows. The same is sensitive to changes in discount rates, tariff growth, toll growth rates, concession period. These variables are evolving, especially in light of uncertainty relating to COVID-19 pandemic. The determination of the recoverable amount of the toll collection right involves significant judgment due to inherent uncertainty in the assumption evaluated for recoverable amount of these rights. According to the evaluation of the impairment toll collection rights has been determined as a key audit matter. So this is the key audit matter in the opinion of the auditor. So how did they address this? We conducted discussion with management to make them understand the impact of COVID-19 pandemic on the infrastructure industries nationwide. We focused on key assumptions that were most sensitive to the recoverable amount of the intangible asset. We also assessed the key assumptions were reasonable and appropriate in the light of the current environment of the COVID-19 pandemic. We evaluated the design and implementation of the relevant controls and the operating effectiveness of such internal controls in estimating the future projections, including assumption used in determining the value in use. We have checked the detailed calculation provided by the management according to concession agreement and the compensation formula determined. On the basis of the aforesaid analysis jointly done with the management, we concluded that no impairment is necessary in respect of the projects of the company. So this way, the auditor has explained the issue, how he has dealt with the issue, and since this was a key audit matter, he thought it fit to report it under SA 701 of the Standards on Audit. The next one is An auditor carrying out the audit of an infra company noted that the excess of current liabilities and over current assets are very large at 50 crores, and the debt to equity ratio is also large. The management, in response to the discussion on the auditor's query as to how they are going to address the mismatch, to this, the management said that they have a claim on a contract of 200 crores and basis that they hope to address the mismatch. The auditor sought the details of the claim calculation, the basis of determination of the claim amount of rupees 200 crores. These management states that these are rough estimates and the detailed working are being made, but will take 2 months to actually work out the exact working and file the claim to the contract. The management does not want to carry any note at this juncture in respect of the mismatched short-term asset liability and the claim on the ground that unless detailed working in place, it will not be appropriate. As an auditor, how will you deal with the situation in forming your opinion and finalizing the auditor's report? So here is the classic case when there is an asset liability mismatch and you are saying that you have a 200 crore claim, but you have not done the working. So your 200 crore claim is a hearsay or a ballpark figure for which there is no auditable evidence. So there is no sufficient appropriate evidence also to know whether the claim of 200 crores is actually there or not there. Even if the claim is there, there is uncertainty whether such a claim and working will be accepted by the party or not. So what this requires typically is a management detailed note on going concern assumption, where the management is required to mention the entire genesis, how they've computed 200 crores and why they feel they're confident, and whether there is an uncertainty that this may or may not get accepted by the audit by the grantor of the concession. Since they have refused to give a note, so to the reader there is an issue and it is not complying with SA 570, which requires complete disclosure where there is a material uncertainty relating to the going concern assumption. Under going concern basis of accounting, the financial statements are prepared on assumption the entities that are going concern will continue its operations in the near foreseeable future. Since the going concern is a fundamental principle in preparation, the preparation of financial statement requires management to assess the ability to continue the going concern. SA 570 casts responsibility on auditor to obtain sufficient appropriate audit evidence regarding and conclude on the appropriate management use of going concern estimates, and whether a material uncertainty exists about the entity's ability to continue as a going concern. If the material uncertainty exists and adequate disclosure of a material uncertainty is not made in the financial statement, the auditor is required to express a qualified adverse opinion as per SA 570. In the basis of qualified opinion section of the auditor's report, state that a material uncertainty exists that may cast significant doubt on the entity's ability to continue the going concern, that the financial statement do not adequately disclose this fact. You cannot say the company is a gone concern. I have told you earlier also when I was doing going concern that even a doctor does not say that the patient is going to die. He says the patient is serious. Please call your near and dear, because anything can change overnight, right? You also don't have to do suit saying that the company is a gone concern. All you have to say that there is a material uncertainty relating to the company's ability to continue as a going concern, and which requires adequate disclosure in the financial statement for the reader to understand. And if they make the disclosure, then also you have to carry a material uncertainty relating going concern paragraph in your audit report and make a cross reference to the management disclosure in the financial statements. In this particular case, they have refused to give any note. Since there is a going concern issue and there is a significant material uncertainty which needs disclosure, and since the disclosure is absent, you will have to qualify your report to state that express a qualified opinion. The qualified opinion, in the basis of qualified opinion, mention that a material uncertainty exists that may cause significant doubt to consider going concern. The financial statement do not adequately disclose this matter. So this is how you will address this under 705 and qualify your report. Now, many of you know, or students must know under Schedule 3 changes also, that many of the CARO requirement, when CARO 2020 came in, they also made the management disclose the similar amounts in Schedule 3. So if you see, many of the CARO requirements are also covered under Schedule 3. So Perfect Trading Limited, a company engaged in the trading of commodities, prepared its financial statement for year 31st March 20XX. While preparing financial statement, the chief accountant did not include the following disclosure. Details the submission of stock statement trade visible to bankers against working capital. So he did not disclose the information in the financial statement as even though it is part of Schedule 3 requirements. Details of application of term loan for the purpose for which they were drawn. He didn't disclose this also, although it is a requirement as per Schedule 3. for students to know, Schedule 3 is the format and disclosure requirements specified in Companies Act for all companies. If you are a IGAP company, then Schedule 3 Division A is applicable to you. If you are an Ind AS company, then Schedule 3 Division B is applicable to you. And if you're an Ind AS NBFC, then Schedule 3 Division C is applicable to you. So under Schedule 3, these are additional disclosures which are brought in so that auditor does not have to report unilaterally. Management also has to report on these matters which are covered by CARO. So details of loans to related party given without specifying the terms or whether they are repayable on demand. There has been a recent merger of a group company and the immovable property yet to be transferred in the name of the company. The title deeds are not in the name of the company was not disclosed. CSR related disclosures, especially towards the unspent amount, were not made. The chief accountant of the company said that these disclosures are to be made by the auditor in their CARO report and they will not add these disclosures in the financial statement. They, however, shared the relevant details with the auditor for the reporting requirement. As an auditor, please inform how will you address this in your audit report. Typically, many people would end up only reporting the figure in CARO because the data that they need is already available to them. As he said, they shared the relevant details for the auditor for the reporting requirement under CARO. Correct? But I have told you that for you to issue a true and fair view, you need to satisfy two things. For you to issue an unmodified opinion, you need to satisfy that the financial statement comply with the reporting requirement of the financial reporting framework. Financial reporting framework is disclosure as per standards and also as per Schedule 3. In this particular case, Schedule 3 has not been satisfied because the disclosure requirement Schedule 3 has not been done by the management because he believes that these all are CARO requirements and you report in CARO, I am not required to report them in my financial statements. So what does this mean? This means that the company has not complied with the reporting requirement of the financial reporting framework, namely Schedule 3. Therefore, although the information for CARO is available, the auditor will qualify the main report by saying the non-disclosure matters stated in the case study amounts to non-compliance with financial reporting framework. Disclosure as per Schedule 3 is part of financial reporting framework. As per 705, any non-disclosure information required in financial reporting framework amounts to material misstatement requiring modification of audit report. Therefore, the auditor needs to qualify the opinion mentioning in the basis of qualified opinion for non-disclosure requirement of Schedule 3, highlighting the nature of which have been not made by the management of the financial statement. In the CARO report on the basis of data shared, the auditor should suitably mention the relevant factual position against each CARO clause. So he will qualify the main report. In CARO, give the full details which have been provided to you. But the main report will have to be qualified under, and in the basis of qualified opinion, you will mention that the management has not disclosed the information required by clause this relating to loans, related to submission of stock statement, relating to usage of term loan, and all those things which are there in the earlier paragraph, relating to default of payment of interest, relating to loans to related parties, relating to immovable property not in the name of the company, relating to CSR related the disclosures, and therefore there's a non-compliance to the financial reporting framework. And subject to that, the balance sheet shows the true and fair view because all other figures are correct. These are only a disclosure requirement. Figures are correct. There's no misstatement in the figures, but there is a misstatement because financial reporting requirement disclosure are not made. So therefore, you will qualify the report under these circumstances. The last of my case study relates to Company A has incorporated 25 branches in its standalone financial statement for the year ended 31st March 20XX. The auditor, while issuing its independent audit report, considered the special purpose audit report issued by the independent chartered accountants on the basis on the branch financial statement. All the independent chartered accountants were local auditors and were not appointed in accordance with Section 139 of the Companies Act. Section 139 of the Companies Act, 139(8) of the Companies Act requires appointment of a branch auditor where there are separate branches. Either the main auditor does the audit of those branches or you appoint a branch auditor similar to the manner in which you appoint the main auditor, which means this, that all the branch auditors are to be appointed by the shareholders, recommended by the management and appointed by the shareholders. So there has to be a list of resolutions where each of the branch auditor is appointed. Now, since this was not done, the auditor used the reports issued by the separate. He got audited financial statements, but their appointment as branch auditor was not done in accordance with section 139(8). Do you agree with the position taken by the auditor? Under section 143(8), where a company has a branch office, the accounts of that office shall be audited either by the company's auditor or any other person qualified to be appointed as an auditor of the company as a branch under section 139. As for the case study, the branch auditor were not appointed as per section 139. Therefore, the auditor cannot rely on such audit opinion issued by the ICAI as the opinion of the branch auditor for the purpose of reporting under other legal and reporting framework. The auditor is responsible for audit of these branches which are incorporated in financial statement and cannot rely on the reports issued by the independent chartered accountants. Since it appears that auditor is not carried out the audit of the branches as is evident from the reliance of the work of DMC, the auditor apparently does not have sufficient appropriate evidence to informing his opinion. And if the total of the branches are substantial and their incorporation is across this thing, he may have to give a disclaimer opinion because he does not have sufficient appropriate audit evidence, and there could be material misstatement because he cannot rely on the audit reports of the ICAI. He has to either do the audit or he has to rely on the report of a branch auditor who has to appoint it as per section 139(8). So therefore, he will have to give a disclaimer opinion if the incorporation of the data of the branches are in multiple facets and there could be pervasive misstatement because the figures which have been taken are not audited. So if there are any questions on this, I'll be happy to answer. Otherwise, I'll do a quick recap of the 2 days for you all, and then we can end the session.
Students, you can ask your queries now. Sir, we can continue with the recap. If I receive any query, I'll let you know.
Okay, fine. So quickly, students, if you remember from the last 2 days, I have told you the audit report is a final document which we are responsible to issue pursuant to the audit done following the various standards on auditing, right from sampling, materiality, audit evidence, etc., management representation, etc. Our responsibility issue an opinion on the financial statements. I have dealt with the facts that only if you have sufficient appropriate evidence to satisfy that there is no material misstatement and you have all the evidences, then only you can issue the unmodified opinion. I also showed you case studies where if any disclosure requirement has not been done, that amounts to material misstatement, and therefore you need to qualify the reports where the figures are correct, but the disclosure is not done as per either the accounting standards or by the Schedule 3, which is the framework for reporting of the balance sheet. So if both of these are not done, that also amounts to material misstatement because it's a reporting requirement which has not been complied with. So if you do not have sufficient appropriate evidence that there is no material misstatement, either due to fraud or error, then you cannot issue an unmodified opinion. So therefore, you will be out of 700 and you will move to 705. Under 705, I have told you that you will give reports, either it will be qualified or it will be adverse or it will be disclaimer opinion. Qualified opinion will be in those situations where one or two particular items of a balance sheet are either misstated or you do not have evidence to know whether they are misstated or not, right? Where you know that multiple items of a balance sheet are misstated. For example, in one of the case studies, I told you that in a consolidated financial statements, since 75% of a subsidiary was not incorporated, you know for sure that the balance sheet is pervasively misstated. Therefore, you cannot qualify the report. You will have to give an adverse report that it does not show true and fair view because non-inclusion of a 75% subsidiary, you have evidence to know that every figure is misstated. So therefore, you will give an adverse opinion, not a qualified opinion. Now, similar is the case with disclaimer opinion. If supposing you do not have access to data and your non-access is for pervasive items of the balance sheet. That means across various items in the balance sheet. I gave you the example of what is pervasive. I told you about being well or not well, and how you cannot say that you're well and say that you have a headache, you have stomach ulcers, you have fracture in the hand, you have some rashes in your hand, etc. You After that also you can't say you're well. You have to say you're not well. You have COVID. You can't say I'm well. You have to say I'm not well. So, but if you have only a headache, you can say, yeah, I'm well, I only have a headache. That means it is localized to only your head. So same is the case with the balance sheet. If only one or two items are misstated, then you can qualify. But if many items are misstated, that means the misstatement is pervasive. It pervades across the balance sheet. Then you will have to give a disclaimer of opinion. So the qualifying correctly or modifying correctly is as important as modification itself. You cannot escape by modifying incorrectly by saying that मैंने modify तो किया, भले मैंने adverse नहीं दिया, मैंने qualify तो किया. That is incorrect because the regulator can take a view that your modification is incorrect, and they have taken a view. There have been instances that the regulator have taken a view. Now that was so far as 705 is concerned. Then came 706, where we dealt with balance sheet is proper, but you want to bring the attention of certain matters to the reader, which is disclosed in the balance sheet. So therefore, you do an emphasis matter where you invite attention to some matter in the balance sheet, which has been properly reflected, but you feel the reader of the audit report needs to know about this matter. So therefore, you do a emphasis matter under 706. In order that the reader does not feel that is a disguised, therefore the reader does not feel that it is a disguised qualification, you will have to categorically ensure A, that the data which is stated is correct, there is no misstatement in that, and B, you also mention that you have not qualified your report on this account. Otherwise, the reader would feel that this is a disguised qualification. That is also the reason why the material and EOM is placed after the audit opinion so that it doesn't bias your opinion. Then we spoke of other matters where if supposing there is some item in the balance sheet which is done by somebody else, right? For example, a branch auditor or previous auditor or a subsidiary auditor, associate auditor, and you have only incorporated his financial statement. You may want to mention this to the reader that I have not done this. This was done by the branch auditor. This was done by the other auditors, and I have relied on the report. So that is will be covered in the other matters paragraph. Same is the case with other regulatory matters where reporting requirement under 143.3 are brought under other regulatory matter, which says proper books of accounts are maintained, the financial statements are in agreement with the accounting standards, there is agreement with the books of accounts, etc., etc. All of them are covered under 143.3 under other regulatory matters. Then we went to 701, where I told you that any key audit matter in a listed company is mandatorily required to be mentioned. What were your key audit matters when you did the audit? So if, for example, you did a very simple audit and it's a listed company and there were no key audit matters, it's a plain vanilla audit, then also you have to carry a paragraph of key audit matters to say that there were no key audit matters to include. For example, or you may have qualified the report. Then also you have to mention that apart from the basis of qualified opinion, there are no other key audit matters because that was the only main thing and you qualified the report on that basis, right? So, but carrying a paragraph on key audit matter is mandatory. It is not a substitute. Whatever is qualified or whatever there is material ancillary going concern, you don't have to repeat it, but you can repeat in EOM as a key audit matter and in EOM. You may have an EOM which is not part of key audit matter or vice versa also. So it all depends upon situations, but there are rules around it, and reading SA 701 will clarify the rules around it. Then we spoke of 720 and what is the importance of 720. We spoke that 720 is required because a reader of an annual report should not have inconsistent data relating to a particular matter which is reflected in the financial statements. For example, I told you that you have not impaired your subsidiary, But in the audit, in the key audit, in the director's report, he says that subsidiary is suffering and there are chances that there will be substantial erosion of net worth, etc. It will take a long time to come back. And he says things which he feels guilty about the subsidiary, but does not allow you to impair it and debit the P&L account. That's an inconsistency. So therefore, you are required to read as an auditor the other information paragraph and so suitably report in other information paragraph of the auditor's report. Then we took you through the disclosure of key audit matters of Infosys. We took you through the other information paragraph Infosys. We took you through how the audit report flow is there in case of Infosys. I showed you in a qualified opinion how the qualified opinion are reflected, how the first paragraph is either qualified, adverse, or disfavourable opinion, and the basis of opinion comes after that. Then we went through CARO. CARO is a more detailed subjective reporting on 20 items which the government wants you to report upon, which the regulator wants you to report upon. Each of this matter, many of these matter are also covered for disclosure in Schedule 3. And one of the cases I told you that accountant did not agree to disclose in Schedule 3, but he gave you all the data for CARO. So while your CARO is clean, your schedule, your main audit report is qualified because it does not satisfy the reporting requirement of the financial reporting framework. You have to read each paragraph. You have to read it with reference to the guidance note. Guidance note is quite good and it explains exactly what are the reporting requirements. Where the CARO does not give you format, the guidance note has given you format for reporting. It is advisable that you follow the guidance note unless your format is you feel is better than guidance note and gives more information than the guidance note, right? So each of the paragraph you have to read and make a factual assertion of the questions asked from you and factually write. Students, don't be under pressure to report something that you are not comfortable upon. As I told in the beginning, as students, as chartered accountants, we are the only privileged professional to do audit. Tax can be done by anybody. A BCom can do a tax, a lawyer can do a tax, a non-chartered accountant can do a tax, but an audit can be done only by chartered accountant. And having that privilege, we need to discharge our obligation under that privilege in a manner which is very, very superior. And therefore, we have to be very clear that we will only report factual assertions. We may have an open mind on all issues, but we should not close our eyes to anything. That should be your dictum. Have an open mind, but do not close your eyes to anything. And accordingly, each of the paragraphs of CARO has to be reported upon. And the last clause in CARO 21 is to be added to the CFS, where you have to go through all the CARO reports of all the components that have gone into the consolidated financial statements, and starting from the holding company to associate. If any CARO negative report is there, you need to give a reference of the CARO paragraph which has been reported negatively. So this is a summation of the audit report. This is the document that we get paid for. This is the ultimate deliverable for us. Our audit comes to an end once we issue the audit report. Thank you.
Thank you very much,
Sir, one of the students is asking,
Yeah.
auditor need to examine all the financial matters and compliance matters and also need lots of information from the management as well as reporting under CARO 2020.
Correct.
How will auditor handle this reporting in case modified opinion and unmodified opinion? Also, please tell few tips for CARO reporting.
Right. So there are two legs to a report. The first part of your audit report is on the financial statements. Okay, where you decide whether financial statements as a whole represents true and fair view and whether you have sufficient appropriate audit evidence to conclude that the financial statement shows a true and fair view or not. That is first part. When financial statement show a true and fair view, if all disclosure requirements are there, there is reasonable assurance that there is no material misstatement either due to fraud or error, and you have followed all these audit standards and accounting standards to conclude that the financial statements are free from material misstatements. So that is so far as the first part is concerned. So if any of this is not satisfied, you'll give an unmodified modified opinion. CARO 2020 is disconnected with your modified or unmodified opinion. Even if you modify your opinion, you'll report on CARO 2020. CARO 2020 is a set of subjective questions asked from you about certain matters which are listed in 1 to 20 clauses of CARO 2020 with various subclauses included in it. This is a factual reporting of conduct of the business by the management, whether repayments are done on time, whether loans have been applied for the proper purpose, whether they have given loans to related parties, what is the percentage they have given, whether they have given loans without stipulation, whether all the assets are in the name of the company. These are subjective questions which you are supposed to examine and answer. Whether you have reported unmodified or modified, CARO is a separate set of questions that you have to answer. Even if you give a disclaimer of opinion on the first section, you still have to answer CARO 2020. You cannot say that I have given a disclaimer opinion, therefore I am not going to answer CARO 2020. These two are separate. They're together for the reader to understand, but their reporting requirements are distinct in the sense that one doesn't affect the other.
Yes, Ankita, is there any other question?
No, sir. No, sir, no more queries.
Okay. Yes, students. Thank you very much, sir.
Thank you.
थैंक यू वेरी मच सर. आपने जिस उससे स्टूडेंट्स को ये वाला सर पूरा ऑडिट रिपोर्ट्स का पूरा ओवरव्यू दिया है सर. पूरा रादर आपने प्रैक्टिकल एस्पेक्ट्स जो थे उनको ब्यूटीफुली एक्सप्लेन किया है. एसए 700 हो या एसए 705 हो, 706, एसए 701, आपने इंटरलिंक करके बहुत ब्यूटीफुली सर विद द हेल्प ऑफ केस स्टडी स्टूडेंट्स को एक्सप्लेन किया है. एंड वी आर रियली ग्रेटफुल टू you. We are really thankful to you, sir, for this wonderful sessions, two wonderful sessions. Thank you very much, sir. Thank you, students. Thanks a lot, sir.
Thank you. Thank you.
Thank you, sir.
Thank you.
Yes. Okay, thank you. Thank you, sir.
Thank you.